Okay, so what we're doing today is 11.3, which is an acquisition of control. And so what we are going to really do is we're going to go through the acquisition of control rules by doing this problem. So there is a video already up, and there is a me walking through an exercise, which is not completely dissimilar from this question. But these are, acquisition of control is a topic that will come up. It's one of the hot, or the kind of standard tax things that UFI always deals, or has in their arsenal. And so it's something that we want to understand. And it's very unique. It's very unique, and I want to drive home the uniqueness of it in the question that we're going to do today. So, 11.3. I've got it up here. I'm sorry this projector is not doing very well, so if you can't see it, then I apologize, but I find no way to make this any better. And so let's just get the facts of this situation down. We have Mr. Buscat, or Buka, if you want to make him more sophisticated. We have that he started a company called Buscat Limited, and he owns 100% of the shares of it. And he started in 2008. And this company has not made money for him yet. Okay, so it has actually lost him money, both in non-capital and in the capital realm. So he has, now it looks like a good trend. It looks like he's losing less. So we don't want to write it off too quickly. We don't know the history of the baking business. What is the normal time it takes to become profitable? We don't know any of that. But what we know is that on July 1st, so we have, here's what we know, or what we can get down. 3 years of losses. How much tax has this corporation paid? How much tax has this corporation paid in its life? Yes, Alan? Nothing. Zip. Nada. Nil. Right? So they paid no tax in their 3 years. So they have 3 years of losses, no tax. We can write that down if we want. That was just really just kind of a pop quiz kind of thing. So what's the next thing that we know? We know that he, for whatever reason, he doesn't tell us why, but he has sold a portion of this on July 1. So we have this other individual, the unfortunately named Mr. Brand. And Mr. Brand owns a company himself. His company is called Buns Plus Limited, which is either a bakery-related thing or a strip club. But it is a bakery-related thing. And so the question tells us, thank you, the question tells us about this bun, yeah. All right, so it tells us about this company. What does it tell us about the company? What do we know about Buns Plus Limited? Well, we know that Buns Plus Limited has been in business for about 10 years and is successful, which we mean profitable. And we know that it has two divisions. It has a bakery division and a coffee shop. And so it actually has three divisions, right? It has for 10 years, it's been very successful. Buns Plus has two divisions, a bakery and a coffee shop, which it intends to transfer to Buscat or Buka. So we'll call Buscat. Transfer to Buscat. But it also tells us that it's really, its bread and butter is a supplier. Right, so it's really a supplier. So this division, it's kind of supplying business where it supplies bread, dough, pastry dough, and bun bags. That is not going. It plans to, after the acquisition, take these two divisions and move them in here. Right? And there will be tax implications to that separate from what we're doing, but it plans to do that. Okay, so what happens on July 1? I won't animate it like I do in such a cool way on the video. Anybody who's seen it, it is something to behold. I actually moved the shares over, but here we're not going to be so fancy about it. We have 25% of, 75% going to him, and Mr. Buscat is keeping 25. Okay, so this happens on July 1, on Canada Day, to celebrate our great nation. They do this transaction. And what is that transaction? Thank you. What is that transaction? What transaction happens on July 1, 2011? I'm really just asking you to read. Yeah, Tanushan.
The Buns Plus guy has acquisition of control.
I agree. The Buns Plus guy has acquisition of control. But what we want to say here is that Mr. Brand buys shares from Mr. Buscat. Okay, that's the transaction. Our taxpayer is Buscat Limited. Our taxpayer, the one that we care about, is the company. So what we have to understand here, when we come to this acquisition, the world of acquisition of control, I really wish we didn't call it acquisition of control. I wish we called it change of control. Because who makes the acquisition? Who's the acquirer? Jackie? Mr. Brand. The taxpayer that makes the acquisition of control is Mr. Brand. He, as a taxpayer, has no tax implications of this, immediate tax implications of this transaction. All of the implications of this transaction are borne by this taxpayer down here, Buscat Limited. And it hasn't even done a transaction. So you have to understand that the transaction that happens is between two individuals. But it triggers basically tax Armageddon for this poor little corporation down here. Okay? And so we're in a different world here. We're used to accounting for income tax. Saying, you earn income, we tax it. Now we have this thing that's really a non-event for the taxpayer itself, and the taxpayer has all these consequences. Okay? But it happens. So, from a tax point of view, what does happen to them? As a result of this transaction happening, our taxpayer has what? Alan? Deemed year end. June 30th, so the day before the transaction. Okay, so the word deem is going to fly around here. So we need, like the deeming, we have to understand what deeming is. So what is deeming? Deeming is saying something is something that thing is not. So what it's doing is it's saying there is a transaction between Mr. Brown and Mr. Buscat. There is no year end for this corporation until I pull out my sword, ask the corporation to kneel before me, and deem it to have a year end. Okay, so I have made it have a year end. It doesn't have a year end. I've made it that. You should feel powerful, right? You have caused this to happen. And that means that year end now, so this is a tax year end. And that deemed tax year end is like every other tax year end, in that you file a tax return. And that tax return will cover from the beginning of the current period to the end of this period. So in our case, that will be January 1 to June 30th. So we have a short tax year. Okay? Also, really important to note, if they'd done this deal and sold the shares on January 14th, deemed year end January 13th. January 7th, January 6th, I can go all the way back. So even if they do this deal on January 2nd, there's a year end on December 31st, and there's a year end on January 1. Okay? Now, they'd be pretty silly to do that in real life, but if they did. So you have to file a tax return. Okay? And so that's not hard. We know how to do that. We know what goes on the tax return. What goes on the tax return? Taxable income. Right? So all that means is, well, we know what to do. Calculate taxable income. Done. What else do we know how to do? Oh, we need to take a look at loss carry forwards that are going to go to the next year. What's going to transfer into the next year. So we know how to do all this stuff. And we're not going to do it any differently because it's a deemed year end. What is going to be very different is what ends up going to taxable income. So very different. And so we do not put our deeming sword away because the implications of this are: 1, all accrued losses on assets. Here comes the word, deemed realized. Okay? So said another way, so give me a paraphrase of that actually, I'll go to you. What's the paraphrase of all accrued losses on assets deemed realized? What does that mean? What does that mean?
Written down to fair market value.
Written down to fair market value. Okay, we'll take it. Written down to fair market value. Anything else? Yeah, Mary Elizabeth?
Usually they would have just waited until it was sold, but now they're deeming that today. It has to be changed to current value.
So deemed disposed at fair market value. So most people will remember this. What most people will not remember is there's an accompanying and what? Deemed reacquired at fair market value. Okay, because at the end of the day, this corporation still owns these assets, right? We can't deem them not to own them. We're not that powerful. All we can do is deem them to have sold them and deem them to have bought them back the very next instant. But all of this happens at fair market value. And there is no choice. Right? This is mandatory. So we're going to meet the elective side of these rules later, but please do not confuse this. This happens to you. You don't have a choice. And you do not have a choice of what the proceeds are. The proceeds are fair market value. So that might be helpful to think about it as a write down from financial accounting, right? In essence, that's what it is. We write it down to its fair market value. And so you can picture the journal entry and the loss happening. Okay, so accrued loss is realized. That's one big thing that happens. What's the second thing that happens on a deemed year end? Judith. A lot of things expire. A lot of things expire. Okay, so, and what are these things, Judith?
Net capital losses carried forward.
Net capital losses carried forward. Okay, gone. What else? Malathi? Allowable business investment losses. Mary Elizabeth? Donations. And Jonathan? Property losses. So please understand that this carry forward matters a lot. That means if they are not used, meaning absorbed, meaning deducted against income in the short year, they die. They're gone. Erased. Amir.
So farm losses would just tie into the net capital loss.
Farm. Good question. I don't know what happened. I'm pretty sure farm survives like non-capital survives. Does anybody know from the I don't recall. Farms are just farms. Farms are very important. We all eat their produce, don't get me wrong, but they're unique from a tax point of view. I'm pretty sure the losses survive. Okay, so what I want you to understand here is that this matters. Why does this matter? This matters a lot. Why? Because the taxpayer survives. Okay, so this is something else we have to understand. This ringer that we are putting this company through, this taxpayer, Buscat Limited is our taxpayer. The ringer that we're putting them through from a tax point of view, they will survive it. So they're going to be bruised and beaten from a tax point of view, but they will go on. Cue Celine Dion, right? They will go on. So the taxpayer survives. And so what we're doing is we're saying you get to go on, but these losses that are part of you, from a tax point of view, a big part of you, they are not going. So Leo is sinking to the bottom of the sea, but Kate survives, right? So the corporation survives, but does she really survive? That's the question. Anyway, so here's... this is why it matters. Okay, what about non-capital losses? So actually, let's make this a separate implication. I think that'll make it clearer. Non-capital losses, do they expire? Jessica.
They can only be used for similar sources of income or business.
Okay, so the good news is they do not expire. They go on with the company. But, as Jessica pointed out, they are restricted. And quite heavily restricted when it comes down to it, restricted to same or similar. And we'll make sure we understand what that means, but those are the words that we want to... In the future, if you are going to use these losses, they can only be deducted against income from a same. So same business is Buscat Limited continuing to do what it was doing, which was trying to sell bread, it looks like. Or a similar business. But hopefully you're saying to yourself, well, that sounds like a spectrum to me. That sounds like my definition of similar might not be the same as someone else's definition of similar. And you'll be right. And we'd be back in the world of court cases and deciding whether you agree with CRA, whether the business is similar or not. And so there's a lot of case law around this. But for our purposes, they'll either be same or similar or not. Okay, so in the question that we're given, they help us to understand that they're both in the bakery business. And so it seems like we should be able to use, if they transfer over a bakery into Buscat Limited, that should be okay. That's a similar business. Okay, and so we should be able to use those losses. Okay. Any other implications of a deemed year-end or of an acquisition of control that we need to think about? So for now, I actually want to leave it as that, because these are mandatory. You have no choice, right? So there's no choice here, no choice here. There's nothing going on about choice. If you have an acquisition of control, this happens to you, and you just do what you're told by the Tax Act. Okay, so let's do that for this company. So for Buscat Limited, the taxpayer is Buscat Limited. What is its income or loss for the year ended June 30, 2011. So we're told that in the period between January 1 and June 30th, before anybody contemplated a sale, they lost $10,000 more dollars. Okay, so we have this business loss of $10,000. Then, and we also have over here in separate pools, so let's just keep them separate. We'll just make a note over here that we have property losses of $5,500, and we have an allowable capital loss, so that's been netted of $2,000. Okay, so we have this. Sorry, let me rearrange this. The property loss can absolutely be involved here. It's not. It's only if it doesn't survive. So let's get it back here. Property loss of 55. Okay, it doesn't need to be in its own pool until we get to the end and figure out whether it can survive or not. So we have profit. So we've hit two of those points, and allowable capital loss we've noted. So then, as a result of this, accrued losses, as a result of this, we have more losses. So let's see what happens to us. We have inventory that is valued at the lower of cost and market, and so its cost is 85, its fair market value is 65, so its loss is 20. Okay, so this was not mandatory, this happened, but this, I'm putting a star here because this is as a result of the acquisition of control. The non-starred stuff is not a result of the acquisition of control, it's just the income or the loss from doing business in the year until before this happened, before the acquisition of control. Okay, the other thing that is a result of the acquisition of control is that they have a bakery equipment that has an accrued loss on it. So the equipment. So everybody in the room, decide what number gets recorded for this bakery equipment's loss. So I'm not sure what the permutations and combinations are. It's probably about 6 possibilities. And which is it? What's the number? Someone raise their hand up there. Who is it? Yeah. Yeah. 16? 16? 16. $16,000 is one vote. Anybody else have another vote? Okay, Mark, tell us how you got it. Did I call you the wrong name? What's your name? Oh, Mook? I'm sorry. Does that cause me a candy? I guess so. I mean, it's not a spelling error, it's a pronunciation error. So Mook, I'm sorry. Why are you laughing? Who's laughing? It's not that funny. Oh. Now that is horrible. Sorry about that. So Mook, tell me, how'd you get 16?
Just subtracted UCC by fair market value.
Absolutely you did that. But what you really did was you said, this is a disposition of a depreciable asset. And I am an expert in that. I know that when there's a disposition, all I do is I remove something from the UCC pool. And what is this something? This something is the lower of cost and proceeds of disposition. Okay, so 1, 2. I have 2 things. So my lower of costs and proceeds are going to come out of the UCC pool. Well, the lower of those 2 is 70. So 70 is coming out of the UCC pool. I'm going to take 70 from my UCC pool, 70,000 from a UCC pool. So step 2 then is to say, well, what's left in the UCC pool? Well, there's no asset in there. So I have $16,000 of UCC. UCC and no asset. So this has to be written down in a terminal loss. Okay, so that's not special to a deemed year-end. That's what we do when we sell, whether we deem it sold or it actually is sold, the treatment is the same. Okay, so anything else happen? We look, they've told us everything about the assets, and so we've done our realizing of accrued losses. The other thing that happens as a result of a deemed year-end is what? A lot of things expire. Well, we don't care about the expiry until after this year's income has been determined, right? So as at this point, point 2 is not relevant to us. So we have everything, all the results of this are in. So we can add this up, and we can get to, what do we get to? 46, 51 and a half. Is that right? I didn't total it on mine, so check my math. Looks like 51 and a half is the loss. Okay, so this is the loss. Okay, so what will happen to that loss? So let's just say what happens to this. Where does it go? This gets added to the non-capital loss pool, except this piece can't go. Right? So really what we'd be adding is 46. The property loss can't go to the non-capital loss pool, but for now, don't worry, we're going to make some of this right, but this will go to the non-capital loss pool, and what will happen to this $2,000 capital loss that was realized in the year? This will be added to the net capital loss pool and immediately expire. So essentially what we do to this company is we say, okay, if a company is going to be sold to somebody else, we don't want the losses transferring. So we are going to expire them. So the whole point of all of these rules is really about they call it loss shopping, is the acquisition of losses, which is slightly inconsistent with what we talked about last week, or last class, same thing. So what we talked about with Division C and being able to move losses across years was, the whole point of that was kind of this fairness idea, that if I have losses in one year and income in another year, those should be able to offset because the year is somewhat artificial. This is saying, if you have losses under one ownership, those cannot transfer to the other ownership, to the new ownership. So that's exactly why they're in place, to prevent losses from being sold, bought and sold. And so it's accomplished, right? It's basically saying, yes, you can take forward $46,000 of loss, plus, so what was added, what was the pool before? The pool before was 60, 45, and 25, which is 130. So the new pool is 130 plus 46. Okay, so that's the new pool. You have all those losses. Those can go forward if that taxpayer continues to make money, or continues to try to make money. And if it's successful in making money, then you will be able to deduct those. That's what our Income Tax Act says. So we're not taking away the ability to transfer losses across years. We're taking away the ability to transfer loss across taxpayers. Okay, very important. Okay. So this is now the point where you say, okay, we're done. We understand how this works. But not so fast. We have the ability to elect. But under the acquisition of control rules, you're given this option to elect to realize accrued gains. Okay, so please understand. So election, understand, not mandatory by the very definition of the word. This is up to you. You can elect to realize accrued gains. But please understand that you can't create gains. You can't say, oh, okay, my asset is worth $1 million. You can't do that. You can only realize gains that are there. Okay, so that's really important to know. You're not really getting away with anything here. This is basically mirroring what they did to you on the loss side. So the rules say deemed losses. Okay, so here's what we'll do. We'll let you realize accrued gains. And why would this be good? Okay, so think about that. Well, I do the paraphrase here. If you elect to realize accrued gains, what you are doing is you are deemed disposition and reacquisition. Okay, so exactly the same as on the loss side. But the big difference is the proceeds, the deemed proceeds of disposition can be anything of your choosing between adjusted cost base and fair market value. Okay? Your choice. Okay? So no choice on the loss side. It's fair market value. On the gain side, you do have the choice. Okay? So we'll look at the quiz at the end. Actually, we'll stop the recording because obviously the other classes, we looked at it already. So we will stop the recording and look at the quiz at the end. And so on the quiz, some people got this question wrong. So what I want you to understand is basically if you elect fair market value, that is equal to electing the maximum. Right? So your textbook talks about a maximum and a partial. What we really want to enforce here is that look, when you look at the set notation, it's pretty clear, right? The fair market value is the maximum of the range. And that's what they mean. When you elect the maximum, you're electing the fair market value, the highest possible. If you elect anything else that's in this set between ACV and fair market value, then you're electing what they call partial, which is also known as optimal, as we'll see in a second. So let's walk through this question as if they elect. So now we will do, let's assume they elect maximum on both building and land. Okay, because you can see from the question they have accrued gains on both. And please understand that they do not have to do both. So it is asset by asset choice. But we're going to say they just go for the whole thing. So if they have an asset with an accrued gain, they deem dispose it at fair market value, and they let it ride. Okay, so all we have to do is we have to say, okay, what is the result of that then? So the result of this is that we will have capital gains. On the land, so the land will be deemed to be sold at 195. 195 minus its cost of 155, and that is equal to 40. So capital gains of 40, and we'll just put the taxable rate beside it of 20. So taxable capital gain of 20. Okay, the building will have, what's the capital gain on the building? Look at those numbers. Fair market value, so the deemed, definitely the proceeds are 75. What is the capital gain? Erica?
20,000.
Okay, so capital gain is no. Where are you getting to? Yes, so you're skipping ahead, that's fine, so keep that in mind. So recapture on the building, you have 20 of 20. Okay, but what's the capital gain? It's capital gain is always proceeds minus cost. So cost is 65. That's 10. So the capital gain is, or taxable capital gain is half of that at 5. And then as Erica pointed out, we have a recapture of 20. So I want to please make sure that you understand why that's 20. And we'll move on. If you don't understand it, please ask eventually. But yes, you're right. The recapture is 20. Okay, so all we've done there is said an election was made. Deem dispose them, deem reacquire them. So the deem disposition created gains and it created recapture. Okay, so what that also does is it says, okay, now when I go to calculate my income for the year, so now let's calculate income for the year. Well, I've got taxable capital gains right here of 25. I have a allowable capital loss, which we are told in the question, of 2. Okay, so that's all of my income. That's 23. Then I have these losses. I have property loss. This is a bit repetitive, but it's worth doing here. I have property loss of 5. I have business loss. These are all losses. Let's just put a heading here. Losses. Business losses, which we calculated before to be 46. Okay, so this includes, make sure we note, includes all the deemed year-end stuff, all those write-downs. Includes. Okay? So we have that business loss, and then we have to take, we say, but, sorry, I'm going to get back to blue, so we have, but we want to take away from our losses, recapture. So that is 20. So when I add all of this up, my losses are actually 31.5. Okay, so division B income then is, now this is, we're doing what we've done before now. So we should be, hopefully feel at least slightly comfortable. Division B income will just be A minus B. But I can look at that, I mean you can calculate it. So what is A minus B? It is 8.5, right? Minus 8.5. But because that's less than 0, it's 0. Okay, division B income does not go negative. However, as we met last time, under division C, what can we do? Under division C, we can decide whether or not to deduct, because we have taxable capital gains. So because we have, let me just note this, because we have these, we can deduct net capital loss carry forwards under division C, right? Like we did last class. This is optional, but we can. And so we have, since we've triggered these gains, we can deduct under division C anything that's available for carry forward. So what is available for carry forward? Oh, come on. Net cap loss carry forward. So what is available? Well, let's just look back at the question. It tells us that they had capital losses of 12, 8, and 4. That is 24. Half of that is 12. So they have 12. So let's just note that's 24,000 times a half. Because there's no inclusion rate conversion to be done because it's all post-2008. All of these were included or incurred in years with half inclusion rate. And anyway, they're giving us the whole gain, so that was irrelevant. Anyway, I didn't need to say that. So under Division C, I can deduct this 12. My taxable income will still be 0. Right? It was always going to be 0. We knew that. It was always going to be 0 because we have this huge loss. So we knew we weren't paying taxes here. We knew taxable income was going to be 0. So just like last time, why did we do that? Why did we take that? Well, we took that because the loss, so the non-capital loss for the June 30, 2011 year end is what? It's the loss that we incurred, so it's B 31.5. And then we can add to that the net capital loss deducted. So we can increase the loss. Okay, so this is what we did last time. It seems weird. This is the overlap between capital loss and non-capital loss. We can increase that by 12, and then, so that gets us to 43.5. But we have to take away what we called up here A, so we will call, but which is really 3C income, but for our purposes here, let's just put A from above. That was 23. So what it's saying is, so what was my non-capital loss for the year? Because you recall, when we go to taxable income, as soon as it goes negative, we set it to 0. So now we have to do is we have to say, well, what was actually the loss? It wasn't 8.5 like we calculated here. It looks like, why isn't it just 8.5? Well, it's not 8.5 because we're going to put back in, we're going to start, I think it's easier to think about it this way. Let's start from what the losses are. They are reduced by the recapture, and so they're 31.5. That's what we have. But we increase them by the net capital loss that gets deducted under Division C. But then, of course, we have this income of taxable capital gains that's there in the first place. Okay? So really what we want to notice here is it looks like there's an $11,000, let's call it excess. What is that? What's going on there? Well, it looks like we've taken in income of $11,000 in order to deduct this 12. So what will that do? So let's first calculate our number. So our number is 20.5. So this answers this question. A non-capital loss for June 30th is $20,000, $20,500. And what will happen to that? That will get added to the carry forward pool. But if you'll recall, sorry to jump around a little bit, but if you will recall, what we were going to add to the pool before was, I'll just scroll up and then we'll write the number. Before we got to this election stuff, what we were going to add to the pool was 46. So we were going to add 46. Now we're adding 20.5. So is that a good thing or a bad thing? Well, our favorite answer to every question is, that depends. Let's first look at maybe what might be the good side of it. What are the new adjusted cost bases of the land? So the new ACB of the land is what? So going into the next tax year, the adjusted cost base of this land is $195,000, right? Because we were deemed reacquired. So basically, from a tax point of view, what's going on here? At fair market value. From a tax point of view, you just bought a piece of land for $195,000. And what that means is, if you sell it on July 1, you'll have no gain and pay no tax. So that's great. What we have just done by making this election is we have sheltered $40,000 of capital gain, $20,000 of taxable capital gain. So we've prevented ourselves from paying tax on that. The question is, at what cost? Well, the cost, the trade-off that we made was, and then on the building, sorry, let's go to the building. The building's ACB is what? Same thing. You are deemed to have acquired it, reacquired it at 75. And it's just, and I would same deal here. So let's just put the arrow there. But then also just a quick note: the UCC is only 70. Why is that? Because the UCC resets to no, that's not true. Now I'm not trusting my notes. Okay, so we'll just put UCC and put a question mark, and I'll have to come back and circle as to where that $5,000 went. Okay, so we have these new adjusted cost bases, which basically what we want to note is that we're sheltering gain. The question is, was this loss here worth it? Because we had to bring in $23,000, how much was it? $20,000 of recapture. And that $20,000 reduces our net capital loss carried forwards. So let's just ask ourselves, when are these valuable? When do these have value? Let's just put like this. These have value if. These have value if what? Chloe.
You expect to be able to earn the income to offset that, to use the loss.
Okay, so one, this company has to be carried on. Buscat Limited must be carried on. Let's just put it this way, carried on with a reasonable expectation of profit. Okay, so obviously if you have profit, you're fine. But you can't, if you carry them on for too long and don't have profit and keep saying, no, they don't, they still need to be around, you're going to have arguments to make. And the second thing is that, well, really, I combine them into one, that's fine. It's really 1 point. But it just needs to be carried on through the year with the deduction. So let's do it this way. Through the year in which they are deducted. Okay, so this company itself needs to be carried on with a reasonable expectation of profit. So it tells us that they plan to do that. So let's just skip ahead and look at, based on what they tell us here. What they tell us here is for the 6-month period ending on December 31st, Buscat Limited had net income of $90,000 from all of its businesses. Okay, so it lost business in Buscat, but the Buns Plus Bakery that was brought over made money, 130, and the coffee shop also made money. The question, and so we know that this loss pool is 130 and change, right? No matter what we do. So how much can they deduct in 20? How much can be deducted in at 12/31/2011? How much of this loss? So it's about 100 and something. So let's just call it 130. So available $130. This is before the what we've added, or maybe it's including added. Let's see what I did. No, this is what got carried forward into the year, right? In the question, 60, 45, and 25. So they have 130 available, and they have profit of 90. if they meet this condition, which they do, how much can they deduct? Well, it's simply the lower of these two things. Right? So you can't deduct losses from, it has to be deducted from profit, but they will be able to deduct all of this. Yeah, is there a question or just itchy head?
I'm just confused as to how we can deduct it because so we're saying that Funds Limited is operating in the same business as Buscat?
No. Make sure we understand that. I'm glad you asked this question. It tells us that what they are going to do is they are going to transfer these into Buscat Limited. So this profit that we are seeing here is of Buscat Limited. It is not during the part of the year the bakery coffee shop of Buscat was transferred. Okay, so okay.
Yeah, I understand, but that's still a different business, though, isn't it? Like,
This is the question, right? So do you quarrel with the bakery side of it? It's why do you think it's a different business?
well, are they like I don't understand what those profit numbers below the initial losses. Like, is it him selling to himself?
Oh, I see what you're saying. Yeah. So no. So this is artificial. Okay, but for the purposes of your being able to use your losses, what they're telling us is we tracked the old and the new separately. In reality, this is they brought them over and everything sort of blended together. But for the purposes of our question, what we want to look at is we want to say, okay, do we have to separate those things out? And the answer, because really you could say I can deduct 130 or I could deduct 145 because, and I would say Buscat losses just continue to add to a pool. The point of this is, no, they don't. At this point, there is no separation between old and new, as long as you agree that what was brought in did not make the old really, really different. So I thought the question you're going to ask is, well, coffee shop? There was no coffee shop in Buscat Limited before. So how can we say that that's a similar business? And it's an interesting point, right? So this is not black and white. I'm not going to say to you, no, it is, it isn't. This would be up for dispute. Is that similar enough? Because really, what does the coffee shop do for them? It helps them sell their product. So really, that's what they're in the business of doing. So you could argue that, yeah, they added a coffee shop, but that doesn't fundamentally change the business and make it different. Or you could say that it did if you're a CRA auditor.
I
Yeah.
just had a question about that. They talked about horizontal integration and vertical integration. So apparently that was a key point of reference where horizontal integration can be argued more easily, whereas vertical integration is more difficult to argue. So is that a point we need to look at?
Well, I don't think so. Here, this is not horizontal and vertical integration. This is transfer of assets into an existing business. So integration is not across corporations here. This is a corporation being changed by what's brought into it. Okay? So, anyway, answer to this question is they can deduct this 90 if you agree that this is same or similar. If you don't, then you say they can deduct less. But they definitely cannot deduct all of what they have. But let's go back now and look at this whole question of trade-off. Right? It looks like we have a trade-off here. That what we've done is we've sheltered future gain on this building, but at a cost of reducing non-capital losses this year. And reducing, therefore, what's available to be deducted in the future. And that's true, right? There is a trade-off. We have achieved something good, but at a cost, right? There's no free lunch in life. So what the act, we remind ourselves, is that we are not, reminder, we are not forced to elect deemed proceeds of fair market value or equal to fair market value. Okay? You're not forced to do that. You can go anywhere down to ACB. And so your textbook calls this the partial method and gives you this rule of thumb. But understand, this rule of thumb does not come out of the Income Tax Act. What it's saying is, I like better this idea of optimal, but your textbook calls it partial. Okay, so just understand that we're in this world. So this is the optimal proceeds of disposition. And before we get to the equation, the rule of thumb equation, what we need to understand is, well, what makes it optimal? Because the word optimal is a relative term, right? It sounds good, right? If we're going to choose this, sounds good, but good is relative. So optimal, what they mean, let's go to the word optimal. They mean optimal for preserving non-capital loss carry forwards. Right? So that's what they mean. So choose the proceeds of disposition such that you will not use up any non-capital losses unnecessarily. So how do we come up with that number? So what we really want is we want a proceeds of disposition that will allow us to use some capital gains that are going to absorb capital losses that are going to expire, but we don't want to trigger the income side of things. So let's see if we can accomplish that. So what we want to do is we want to have these proceeds of disposition be equal to the adjusted cost base of the assets. Okay, that's the starting point. So if we did that, if we elected at ACB, so in the case of the land, look at that. If we said, okay, instead of electing at 195, I'm electing at 155. What have I accomplished? Nothing, right? I've accomplished, what I've done is I've actually got nothing, right? I have no gain, no loss. I sell it, I acquire it, and nothing changes. So that's clearly not good enough because I have triggered no gain, right? So here, let's just remind ourselves. Preserving non-capital losses while triggering capital gains to absorb or to use, let's say, use net capital losses that will expire. Okay, so I know it has to be above ACB because that's what the Act says. ACB is the bottom. So it's either going to be ACB or something bigger. And it's going to be bigger. And it's going to be the losses that are expiring. So what I want to do is I want to trigger proceeds equal to the losses that are expiring so that I can use up those losses. Seems really easy. One more piece, though, we have to think about. We have to trigger 2 times that. Why do we have to trigger 2 times that?
Because the losses will only be included at half.
Right. Because we need this optimal proceeds of disposition. Because what we know the capital gain will be equal to the proceeds, so this number that we're calculating, minus ACB. So the second term will fall out. And the gain will be equal to whatever we have here. And so we need it to be 2 times because we are going to apply, to get to taxable capital gain, we're going to apply a half to it. So we need 2 times the losses so that once we apply half, we end up with a taxable capital gain to cover the losses that are there. Okay? Hope that, anyway. These equal signs don't make mathematical sense, but hopefully the explanation makes some sense. So let's just do this and say it's like this. This is 1 divided by the inclusion rate. Because we are triggering capital gains, and they will be included taxable. So what is our number here? So let's assume that we elect on the land only. Okay, so for the optimal, because how do we know? I mean, we don't know until we actually do the calculation, but how do we know we don't want to elect on the building? We know we don't want to elect on the building because of the recapture. Right? The recapture is automatically going to wipe out $20,000. And if our whole goal is to preserve non-capital losses, that goes against it. Electing on the building in general goes against it. So what we will do here is we'll calculate our optimal proceeds. So our optimal proceeds of disposition in our case will be 2 times a bunch of things plus 155, which is the ACB of the land. The things that are about to expire are the allowable capital losses about to expire. Let's just put allowable capital losses expiring. Plus the net capital losses from that were carried forward into the year. You could pool those if you wanted to, and then the property loss. Okay, so we know that if there were ables, if there were donations, we could put them there, but there aren't in this question. And so our allowable capital losses expiring from this year are 2,000. The ones carried forward are 12,000, and the property loss is 5,500. Okay, so those are our numbers. We do that, we get proceeds of 194. What were our deemed proceeds under the maximum election? Just remind ourselves, under max, our deemed proceeds were $195. So we're doing all this for $1,000. But remember, before we included the building, so it's not going to line up perfectly. But right now, so we really on the land, it's just $1,000 difference. So what does that mean then? So we have to go through all of this again that we did before, but we can do it quicker. So taxable income calculation is taxable capital gain will be 194 minus 155 times a half. That will give us 19.5. We will still have this allowable capital loss that can be deducted. So that will get us to 17.5 of income. Right? Then we will have the same thing we had before. Property loss of 55. Business loss, of 46. Okay, none of this changes. And now we just notice that the recapture is not here. So you can either just ignore it, but I'm writing it there so we know that we have triggered no recapture. We know there could never be recapture on land, but we also know that we have not elected on the building. There's no recapture, just to line up with the other one. So if you wanted to leave that blank, that's totally fine. What that means then is our loss is 51.5. So our losses added up are 51.5, which means our income is 0. Right? It's negative, understood, but it's capped, so it's division B. Our division C deduction is exactly what it was before. We have 17.5 of gain. We have available to deduct. The net capital losses available are 12, so we can take all of them. So that's 12. And that gets us, again, to taxable income. Still 0. You think, I know people out there are like, I don't understand why we're doing this. Why are we deducting 12 from 0 to get back to 0? And you say, well, there is no point. If you're looking only at taxable income, there's no point. But the reason we are doing it, the reason this is done here, is that when we look at the loss for the year, we do it just as we did it before, and we get 51.5. We add this deducted amount, so deducted under division C of 12. Okay, and that gets us to 63.5. And then we take away the income. So what is our income in this case? 17.5. And that gets us to, I didn't do the number, so that is 46. Which is the circle of life, right? We know what, so that what is that 46? I won't scroll way back up because it's way up there. But that 46 is the non-capital loss that we calculated with no election, right? So this was equal to the non-cap loss with no election. So we have achieved our goal, at least partially. But let's see if we've achieved it fully. What will be the ACB on the land? The new ACB on the land will be, what will be the new ACB on the land? 194, right? Because we deemed to have bought this thing just like before. Deemed, bought, right after we sold it at the proceeds. So there is $1,000 of gain that will be subject to tax, but we've sheltered $39,000 of taxable capital gain by doing this, without the cost of lost non-capital losses. Right? So we've achieved what we wanted. We preserved all our non-capital losses, and we used up net capital losses. That's the whole point of taking the optimal election. So if we look at what's available for carry forward, we have, I won't bother scrolling back up, but we have like 20, I think it's 23,000 extra dollars to deduct. It's in that range anyway. Yeah, 20, going forward it's 24, 25.5. We have more to deduct. Okay? So I know that this is overwhelming in its, when you first come to it, but if you can stop yourself and say, okay, really, what happens here is things happen to them. Things happen to the taxpayer on the acquisition of control. Their losses are deemed realized. Nothing they can do about it. They lose all of their expiring losses if they don't make an election. So here's a nice exam question that tests understanding rather than memorization of application. Are you better off making the maximum election or making the optimal election? And your answer to that question has to be, I don't know. Or better yet, it depends. Depends entirely on what? What? Yeah, Jackie?
How much income you expect to earn in that same business?
Right.
Same
My expectation about the ability to use non-capital losses in the future. So understand, you're taking on risk. As soon as you say the word expectation, you're taking a risk because you're guessing about the future. But it's basically trading off your expectations about the ability to use non-capital losses versus, so here's another thing. What if there was a case fact that said, and then the numbers here are not very nice because there's the $1,000 difference, but what if that 1,000 was a lot bigger on the land? And what if there was a case fact that says they're planning to sell this land in the next 2 years? That changes everything. If they're planning to sell that land in the next 2 years, that means that they're planning to actually realize that gain. And therefore sheltering it is really valuable to them. Or if the case fact said they plan to never, like I think I used this before, they'll never sell that piece of land, then you would say, okay, then sheltering that taxable capital gain is really not that big a deal because they'll never realize it. Right? So they'll never pay tax on it anyway. Never being relative in that sense. Okay? So this stuff, I think, will, with practice. So next class, we're going to do essentially another one of these differently so that you get some sense of what it is. Why it's a nice topic is because we need our knowledge from the other stuff. And so why you're struggling more than maybe you might be is that our foundation that we laid last week with Division C, I don't think is solid enough yet. But that'll come with time. Let me turn off the recording. So see you all in recording land.